Explore the intricacies of investing by delving into the historical and psychological aspects of financial markets. In today's investment landscape, marked by unpredictable market swings, fervent speculation, and intricate financial products, the journey may feel like navigating a complex minefield, where excitement can lead to confusion and potential pitfalls. However, the path to building lasting wealth doesn't demand the ability to predict every market twist. The most profound insights into investing don't arise from complex formulas or speculative forecasts. Instead, they emerge from a deep understanding of the past. History serves as a guide, shedding light on timeless principles and common pitfalls that shape the journey of every investor. By drawing lessons from the successes and failures of previous generations, we gain valuable perspective, enabling us to make more informed and prudent decisions in the present. This exploration goes beyond the surface, distilling critical knowledge from historical experiences. The goal is to equip you with the insights needed to navigate financial storms successfully and work toward achieving your long-term financial goals. Embark on this voyage of discovery to unravel the enduring pillars that underpin successful investing, empowering you to make strategic and informed choices in today's dynamic financial landscape. Pillar 1. Those who don't learn from history are doomed to repeat it. Achieving success in investments necessitates a profound understanding of financial history, as patterns of speculative manias, bubbles, panics, and crashes tend to recur approximately once a generation. Even with a comprehensive grasp of financial theory and psychology, failure as an investor is likely without learning from the mistakes of the past. To embark on this journey of understanding, let's delve into economic history to identify recurring trends. At its essence, technological innovation serves as the driving force behind productivity gains, economic growth, and increasing prosperity, constituting the primary engine behind long-term stock market returns. However, what matters most is not the absolute level of innovation but the rate of progress. A sudden halt in innovation would disrupt corporate profits and result in stagnation rather than continuous growth. Crucially, technological progress is characterized by intermittent bursts and blooms, rather than a consistent, accelerating pace. A profound example is the explosion of innovation from 1820 to 1850, marked by a tenfold increase in transportation speeds through railroads and the emergence of near-instant communication via the telegraph. The transformative impact on daily life during this period is challenging to fully comprehend today, considering that just a few decades earlier, the fastest mode of transportation was a galloping horse. An insightful analogy to understand the diffusion of technology in the economy is comparing it to water from an old hand pump. The irregular flow at the pump handle symbolizes innovation, while the steady stream at the pipe's end represents consumption by the average consumer. The allocation of capital between these 2 points is a crucial determinant of investment returns. Interestingly, historical data indicates that investing in pioneering technologies has historically yielded low returns. Early investors in groundbreaking inventions, such as automobiles and radio companies, experienced poor results, emphasizing that the success of a product is not solely based on its merit but on the enthusiasm of the public. Enthusiasm, however, occurs in brief episodes. It is during these short waves of public excitement that industries defining an era receive capitalization, and dominant companies emerge. In the absence of such enthusiasm, investors providing capital for unproven technologies typically experience disappointing returns. In summary, path-breaking inventions thrive only in those rare instances where they capture the attention and enthusiasm of the public. Pillar 2, sound investing is a game of patience. The roots of modern stock markets trace back to 17th-century Europe, where brokers convened in London's change alley coffeehouses for share transactions. As financial tools evolved, public investment in emerging technologies became feasible. The emergence of investment bubbles accompanied these developments, exemplified by the 1687 diving company's bubble in England. The diving company's speculative fervor unfolded when William Phipps, an investor returning from salvaging Spanish treasure, captivated the public. Patents for diving bells proliferated, leading to a surge in shares of these companies. However, the bubble burst when investors realized that most companies lacked operational and profit development, resulting in substantial losses, akin to the dot-com crash centuries later. Speculation in ventures with low probabilities is not inherently problematic. However, irrational exuberance and a departure from rationality can create bubbles. Economist Hyman Minsky outlined preconditions for such bubbles: the introduction of a destabilizing technology or financial innovation, easy credit access, collective forgetfulness of past bubbles, and an influx of inexperienced investors dominating markets. When combined with irrational euphoria, these factors lead to financial mayhem. Examining the dot-com bubble in the late 1990s illustrates this cycle. A new technology, online trading, loose credit, collective amnesia about past crashes, and widespread euphoria. The cycle progresses through displacement, easy money, amnesia, and euphoria until prices detach from reality, fueled by greed. Historian Charles Kindleberger noted that witnessing a friend's wealth accumulation is distressing, contributing to the mania's self-perpetuating nature. The cycle continues until borrowed cash is depleted, leading to a collapse. This boom-bust cycle transcends centuries, currencies, and assets, with varying specifics but consistent psychological dynamics. Investors today must comprehend these dynamics for sustainable investing. Sound investing involves patience and perspective, resisting manias amid the heat of the moment. A sober evaluation of risk and reward becomes a protective shield when others succumb to irrationality. While historical knowledge doesn't provide perfect foresight, it serves as essential ballast for navigating the perilous journey of every investor.
If you find value in our content, we'd appreciate your support through likes, shares, and subscriptions. Your comments are not only our guiding star but also the foundation of our progress. Thank you. Now, let's dive back into the review.
Pillar 3. When it comes to investing, humans aren't as rational as we'd like to think. In the realm of economics, a fundamental assumption posits that individuals behave rationally, acting in their self-interest when making financial decisions. However, ample evidence contradicts this notion, revealing that irrationality frequently prevails, causing individuals to act against their own financial interests. Until the 1970s, the field of finance largely neglected the impact of irrational behaviors on investment returns. Economist Richard Thaler played a pivotal role in changing this perspective by pioneering the discipline of behavioral economics. This field scrutinizes the irrational ways people mismanage money. Thaler's initial focus involved cataloging everyday contradictions, such as individuals braving adverse weather conditions to attend events they've already paid for. Real-world observations exposed the consistent discrepancy between conventional finance theories, which assume rationality, and people's actual behaviors. During the same decade, psychologists Daniel Kahneman and Amos Tversky delved into cognitive biases affecting decision-making. Their research, elucidating systematic mental errors related to estimating probabilities and risks, laid the intellectual groundwork for uncovering irrational investor behaviors. 3 particularly costly investing behaviors emerged from their work. The first is herd behavior, deeply ingrained in human social nature. People often find comfort in following the crowd and adhering to popular trends. However, in investing, herd behavior proves perilous. As investors rush to buy the same hot assets, stock prices become overvalued, leading to detached valuations, plummeting returns, and a mass exodus when reality sets in. Succumbing to short-term trends ensures buying high and selling low, yet the safety in numbers and the ease of following the crowd often outweigh independent thinking. The second costly behavior is regret avoidance. Humans, averse to admitting mistakes, resist selling losing investments in the hope of a rebound, driven by the desire to delay confronting failure. Objective re-evaluation based on future potential, rather than past performance, should guide sell decisions. Emotional avoidance of regret often results in pouring more money into doomed positions, compounding losses. The third and final costly behavior is mental accounting, segregating portfolios into winners and losers. Individuals tend to fixate on small successes while overlooking larger failures. However, only total returns matter in the grand scheme. Focusing on isolated instances of success is delusional if the overall investment strategy is flawed. These inherent human tendencies, among others, corrode wealth, akin to rain eroding unprotected hillsides. Rather than confronting losses, individuals often treasure wins and bury losses, enabling the avoidance of overall portfolio failure. Success begins by acknowledging human irrationality, paving the way for intentional strategies to counteract these tendencies. Self-awareness, knowledge, data tracking, and disciplined rules empower individuals to overcome self-sabotaging behaviors. Objectively monitoring total portfolio returns, learning from mistakes without emotion, establishing systematic discipline, and avoiding seductive narratives used to explain randomness form the keys to navigating markets more rationally. While human nature cannot be defeated, understanding its obstacles allows for a more rational approach to investing, with the real battles taking place in individuals' minds. Pillar 4. With training, you can learn to tame irrational impulses. Conquering the inherent investing shortcomings rooted in human behavior is a formidable yet crucial challenge. Through consistent effort and self-awareness, individuals can mitigate these natural impulses, substantially enhancing their investment returns. 6 sound strategies, outlined below, offer actionable steps for implementation. 1. Avoid overconfidence. Acknowledge the fallacy of believing that one can outsmart the market's seasoned professionals. Historical data overwhelmingly demonstrates that even proficient investment managers struggle to match, let alone surpass, market returns over time. Recognize the efficiency and intelligence of the market and embrace it by utilizing index funds, a revolutionary investment innovation that allows individuals to align with market returns efficiently. 2. Ignore short-term top performers. Resist the urge to base decisions on the recent top-performing investments of the past decade. Following yesterday's winners often succumbs to the herd mentality, which proves erroneous in investing. Over a multi-year horizon, the concept of reversion to the mean indicates that today's winners may become tomorrow's losers. Short-term past performance rarely predicts future returns. 3. Cultivate dullness. Opt for a less exciting investment approach by avoiding high-risk assets and opting for ostensibly boring indices. While exciting investments may attract attention, their long-term returns tend to be lower. Diversification and asset allocation help tame volatility, enhancing wealth accumulation. In investing, embracing the mundane can lead to more significant financial gains. 4. Acknowledge uncertainty in picking winners. Recognize the human bias to focus on successes and overlook failures. The endeavor to pick the next corporate giant is fraught with uncertainty, as thousands of startups fail. Mitigate survivorship bias by owning the entire market, ensuring automatic inclusion of potential big winners. 5. Avoid forecasting narratives. Steer clear of the allure of predicting future scenarios. The complexity of the world, coupled with unforeseeable black swan events, renders forecasting unreliable. Macro outcomes, interest rates, and market movements remain elusive to accurate prediction over extended periods. 6. Temper loss aversion. Objectively assess total portfolio returns rather than fixating on individual stock movements. Evaluate strategy success based on overall progress toward financial goals, recognizing that some stocks may experience declines while the total portfolio compounds over decades. 7. Exercise patience. Acknowledge that investment success is a gradual process that unfolds over time. Compounding, a powerful mathematical principle, requires decades to yield significant results. Maintain patience and allow proven methods the necessary time to produce substantial returns. Overcoming the irrational aspects of human nature in the realm of investing demands ongoing diligence. Awareness, aligned incentives, and structural frameworks can guide rational decision-making. Admitting ignorance, suppressing ego-driven impulses, avoiding seductive narratives, and resisting stimulus-driven actions contribute to the cultivation of a resilient portfolio that can withstand the test of time and steadily accumulate wealth over a lifetime of investing. Final summary: navigating financial hazards through history. Examining financial history uncovers recurrent patterns of speculative manias and crashes, emphasizing the inherent risks in financial markets. The key takeaway is the significance of compounding wealth through resilient portfolios and extended time horizons, prioritizing sustainable growth over succumbing to short-term financial predictions. Drawing insights from historical speculative pitfalls equips investors with the perspective needed to resist frenzied moments and make judicious investment decisions. The lessons of the past underscore the wisdom of enduring principles in building a robust financial future. Welcome to one of the finest personal development book summary channels on the internet. We're thrilled to have you join our amazing community that values growth and strives for improvement. Your support is instrumental in our channel's progress, and we deeply appreciate your engagement. In return, I commit to delivering consistent and valuable content, enriching you with knowledge and inspiring you to take meaningful action. Thank you for staying tuned and being a part of this journey towards continuous improvement.